welcome to the TechWise Financial Planners Podcast. Very excited for today's show. With me here today, I have Brian Enriquez from BMO, and we're going to be talking today. Now, before we get too far in, though, I have a couple of just disclaimers we have to get out of the way. We are going to be talking about investment advice and services today. So these are not bank deposits. They are not insured by the FDIC or any other entities, and are subject to investment risk, including possible loss of principal amount invested. And no advice or information, whether oral or written, obtained from through the podcast or through our websites and things like that will create any kind of warranty not expressly made wherein. All right, now we've got all the lawyer speak out of the way. Brian, thanks for coming out today and talking with us. Guys, tell me a little bit about your background.
Yeah, so really appreciate having me, Evan. So again, my name is Brian Enriquez. I'm actually with a company called Barnabas Capital. So we are a third-party distribution company, kind of like a hired gun for some of the largest investment banks in the world. And what we're going to be talking about today is specifically, we do represent Bank of Montreal, or BMO, in the structured note space. A little bit about myself, my background, been in financial services for about 14 years now. Initially started off in operations at MetLife, and then eventually got into sales, primarily when it came to variable annuities and annuities in general. And then eventually got into structured notes when I moved to South Florida with my wife. We moved for her job, and so at that time I had to figure out what I was going to do, and eventually found a structured notes wholesaling desk in Boca. It's actually the mecca for structured notes wholesaling desk. There's about 4 different companies down there that wholesale these particular types of investment solutions, and have been doing that for about 7 years now, and have never looked back because of just how intriguing these investment solutions are and just what they're able to do for clients and mitigating risk within their portfolios.
Exciting. Yeah, so the reason I brought Brian on to talk with us today is a lot of times I find that people, when they think of investing, they only think of stocks and bonds. And as we know, that the world has quite a bit more options out there. And so just wanted to bring Brian on, talk a little bit more about some of the other options out there. Full disclaimer, here at TechWise, we do use some of these structured notes. So I thought this would be a good opportunity to hear kind of straight from the horse's mouth a little bit about how they work. So Brian, I guess tell us a little bit about what exactly are structured notes.
So structured notes are debt instruments that are issued by banks. If you think about it, banks are constantly trying to find new ways to get capital in the door. And they can issue stock, but that would mean that they have to give up equity or ownership in the company. They'd rather issue this debt. And with that debt, they typically pay a stated rate. You might know these things as bonds. So they can issue bonds, and there's going to be a market for people that will buy their bonds. But in order to get a broader array of clients in the door, what they have essentially done is they've taken that bond component and packaged it with options in order to get defined outcomes. If X happens, then Y is your outcomes. And these solutions are becoming extremely popular, effectively doubling in size over the course of the last 7 years. And they are now a $100 billion industry because of their ability to, again, mitigate risk within the client's portfolio, but also allow them to have the ability to participate in the markets up to a certain level, or even produce income in some cases.
So if we were thinking about this kind of like a sporting event, what I'm hearing is that the bonds are kind of like if team A wins, we're going to pay out a certain fixed rate. Okay. So we know the defined outcome on that, if that's going to happen. What it sounds like these might do is it might allow you to say, if the team wins by this much, or if they lose by this much, we can kind of pick our own outcome rather than just a stated one like with the bonds. Is that a kind of a fair analogy?
Exactly. And when you introduce that element of if X then Y, there are infinite amounts of different outcomes that can happen, right? There are different infinite numbers of ways to structure these things so that what happens is you have over 200 options every single month. And our job is to really kind of hone in on what it is exactly the client's looking for and point them in the right direction of the particular type of structured note that might benefit them the most.
Gotcha. So what would be some of the benefits of us being able to kind of pick our defined outcome?
I would say it's the fact that you don't have to fit a square peg into a round hole, right? So if you have a portfolio where there's certain monies that are going to be more conservative, you can look at structured notes that have full downside protection. If you have a portion of the portfolio where you're looking for fixed income or you're looking for some sort of yield, we can look at income notes. And if you just have a portion of the portfolio where you need the ability to capture equity-like returns, but maybe you don't have the time horizon to be able to recover from a big pullback or recession, you could potentially be looking at some of the buffered notes or some of these dual directional notes where you can actually have a positive return even in a down market. That's the reason why these structured notes have become so popular, is because they're tailored specifically to whatever it is you're looking for within that segment of the portfolio. And yeah, on any given month, there's going to be hundreds of options, and it's our job to basically try to find the best ones for whatever it is the client's looking for.
Gotcha. Now you mentioned something at the very beginning of that. You said downside protection. Maybe explain that for the listeners in more layman's terms. What does that mean, downside protection? Are we shorting stuff? What
Sure.
does this mean?
So one thing that you want to make sure you understand when it comes to structured notes is that they all have certain durations. So these durations can range anywhere from 13 months all the way out to 5 years. And there will be a preliminary prospectus or a legally binding document that says you have, if X happens, then Y is your outcome. And so if we're tied to a broad-based indice, at maturity, that indice can be positive or negative, right? So if it's negative, you can pick certain solutions that have these things called buffers. And you want to think of a buffer like a sponge. It is absorbing losses for you on the downside. So let's say the stated buffer on a 13-month note is 10%. If you are down anywhere from 0 to 10, that sponge has absorbed all those losses and you will just get your money back. If you are down beyond the buffer, let's say you're down 12%, you only lose 1% for every percentage point beyond that buffer. So in that example, where the buffer is 10% and the market's down 12, you only lose 2. So it becomes a situation that regardless of what amount you're down, you're actually in a much better position than you would have been had you invested in the straight up ETF or individual index, because of its ability to absorb the first 10, 15, 20% of losses with that buffer. And with structured notes, again, the inventory will come out on a monthly basis, and you'll get to basically look through that inventory and decide what type of time horizon you have, whether it's 13 months or 5 years, and what level of protection you're wanting to get, whether it's 10%, maybe 30%. It's all going to be stated for you in that legally binding document at the beginning of the month.
Interesting. And I always like to use kind of real numbers as examples. So let's say if I have $100,000 and we have a 10% buffer. So if I put that $100,000 into an ETF that tracks that index and it's down 10%, I now only have 90,000. Well, what you're saying is that if I had instead used the note at the end of that time period, I would be hand me back $100,000. Is that correct?
Exactly. The investment bank would dictate your performance based off your initial purchase payment, and thus, if you were down but not down more than the buffer, your full principal would be returned.
Gotcha. And then if it was down 12%, as you said, the ETF I would have had would be at 88,000. But in our scenario with those terms, I would get a check back for 98,000. Yes, that's correct.
Spot on. Exactly right. Yep. Mm-hmm.
Perfect. Great. Now, I think you mentioned that there are some options for income. So how could something like this generate income?
Income, you have the same types of durations, anywhere from 13 months all the way up to 5 years. With income notes, I try to break it down into three components. Typically, how does the coupon work? How does the call feature work? Because most of these are callable. And then how do I get my money back? So at the beginning of the month, they're going to give you a stated rate, typically anywhere between 6 and 9%, I would say. That's what the coupons are per year, typically paid out monthly or quarterly. And they usually have a contingency. That contingency is typically linked to some broad-based indices or individual stocks. And it basically says, as long as these underlying indexes are not down a certain amount, typically anywhere between 25 and 35%, you will get your coupons. So let's say, for instance, right now there is an income note that I'm thinking of. It's an 8.5% coupon tied to the NASDAQ, the Russell, and the S&P. As long as those three underlying indexes are not down more than 35%, you will clip that coupon. Now, as far as the call feature works, typically these are either auto call or issuer call. Auto call just means it's binary. It either happens or it doesn't. If the underlying indexes are all flat or up, you automatically get called. If it's an issuer call, it's just at the discretion of the issuing bank. But if you get called out, it's actually a good thing because you're going to get 100% of your money back at that time, and the contract's over, and you also get the last coupon, the monthly coupon that you were owed for that month. And then you get to reevaluate your objectives, whether you want to go back into something very similar, or if you want to pivot and go into something else. You have that ability if you get called out. Now, let's say you make it the full 3 years, never got called out, and we basically have held this thing for a full 3 years. What happens then? As long as those three underlying indexes are not down more than 35% in my example, you get 100% of your money back. The doomsday scenario that exists is if you're down more than 35. It has to be at maturity. It does not matter what happens from inception to maturity. You could have a flash crash where you're down 40, but then you recover and you're only down 25. You would still get your money back. But if at maturity you're down 36, you got to keep all the coupons that you got along the way, but your, let's say, $100,000 investment is now going to be $64,000. You are down the full amount if you breach that barrier of maturity. I like to think of it kind of like a glass floor. It supports you until it doesn't. So again, if you were down 34 at maturity, you get your money back. But if you're down 36, you broke through that glass floor, you're going to be down the full amount.
Gotcha. And just to clarify, when you talk about coupons, what you really are meaning is the interest payments for
Exactly.
All right, so that's great for the income. And I think the last one you mentioned was something called dual directional notes. Can you tell us a little bit more about how the dual directional notes work?
Sure. So dual directional notes are another within the category of what I call protected growth. So these are really growth-oriented types of products. And what you're doing here is, again, you're selecting your duration. They come anywhere from 13 months all the way up to 5 years. Our most popular one right now is a 3-year S&P 500 dual directional note, where you typically have some sort of cap on the upside. And let's call that cap 40%, okay? So you participate 100% in the performance of the S&P 500 all the way up to 40%. So if the S&P 500 was up 30 and you invest $100,000, you'd be walking away with $130,000. That's how the upside works. On the downside, it has a 20% buffer. So if the S&P 500 was down 21%, you would only be down 1. It's a lot easier to climb out of a hole 1 than it would be to climb out of a hole of 21. Where this is different, though, from a buffered note, when we look at dual directionals, is what happens anytime we're down somewhere between 0 and 20. And again, this is at maturity. What happens is that you flip the negative performance of the S&P 500 into a positive. So let me go through some examples. So if the S&P 500 was down 10%, not only would you get your money back, but you would also get a 10% return. If the S&P 500 was down 20%, not only would you get your money back, but you would get a 20% return. It is one of the few investment solutions that gives you the opportunity for a positive return, even in a down market.
Interesting. But once we break that, I think as you called it earlier, glass floor, then we start participating in potential losses, correct? So it's not like we would get,
Correct.
if we're down 21%, it's not like we would get 20 minus 1. We would just go straight to the minus 1.
Exactly. It is a buffer, so it's more like a sponge, but you're absolutely correct. Down 21 means you're only down one. You don't get the accumulation of the dual directional that was happening in the background at maturity. It's basically just what were the levels at inception, what were they at maturity, and based upon the performance at that time, if you're down from 0 to 20, you have that dual directional flipping the negative into a positive, but anything beyond that, it works like the buffer.
Well, from a risk standpoint, then, like, I guess, how is this different than just regular stocks and bonds? How do they compare in there, and what are the risks?
Sure. So relative to a traditional stock or bond, I always think of stocks and bonds as these complements to each other, right? They fit in different aspects of the portfolio. And the stocks are traditionally going to be situations where you take on more risk, but you get more reward. And then the bond piece is going to be a situation where you take on less risk, but then you also get less reward. I feel like structured notes kind of fit right in between there, where you can have a situation like these buffered notes where you have full exposure to the market on the upside without having to bear the full risk of the market on the downside, because of the fact that you have that buffer or that sponge absorbing some of the losses for you. So with that being said, it's a nice little complement to what stocks and bonds can already do, where you can have something that has a little bit higher reward potential without having to take on a situation where you don't have, or you have a little bit less risk than you would had you invested in the straight option of a traditional stock. But it does come with risk. The major risk that you're taking on when it comes to structured notes is going to be credit risk. So you're effectively buying the paper of the institution. So I mentioned at the beginning, we work with
by buying the credit of that, what you mean is that you're lending money to the bank, is what we're doing.
Correct. You're lending money to the bank. And we work with a variety of different banks, whether it's Barclays, BMO, Citi. What you're effectively doing is lending them money, and in return, you have a debt obligation from them. And that debt obligation is something that if they were to go bankrupt, you would then be in line at a level called senior unsecured debt. And so it can be a situation where if the bank defaults, then you would be, again, in a bankruptcy situation where you're a creditor waiting in line for the court proceedings to effectively understand what it is you would get in return. But with that being said, we work with some of the largest investment banks in the world. We also live in a world where after the financial crisis of 2008, there are so many more regulations and capital reserve requirements that exist. We look at these bank sheets of these banks on a quarterly basis, and they're very, very well capitalized. BNP, for instance, has $500 billion in liquid cash reserves. So effectively, they would have to run through or burn through that cash before they would even have to think about liquidating any of their assets. And so that's just one example of how these banks are very, very well capitalized in order to be able to overcome any sort of run that they would have on the bank.
Well, now, Brian, so the listeners here all want to implement a really faith-based or values-based investment plan for their portfolios. So while these sound really interesting, what makes them, biblically responsible, or how do they align with that goal?
So when it comes to structured notes, you can decide what the underlying investment is going to be. Thus far, primarily what I've been talking about is linking it to like a broad-based index like the S&P 500. But what we have found is that there is this desire for faith-based types of investments, solutions that will align with people's beliefs. And so we actually attended a Certified Kingdom Advisors Conference. This is a conference that is primarily faith-based oriented investment solutions. And we were fortunate enough to meet with a company called Inspire ETFs. They are one of the world's largest ETF providers of biblically responsible investment solutions. And after having this deep conversation with them and realizing how much we were aligned. Barnabas Capital is actually a faith-based organization. Our name is biblical. We realized that there was an opportunity for us to create the first and only biblically responsible structured note in the marketplace today. We were surprised that there actually is not one available right now. And so at that time, what we did was we basically looked into Inspire, realized that they have this way of creating an impact score, if you will, where they look at all the different stocks in the marketplace and assign them a score based upon how they are a blessing to their community, their workforce, and the world in general. And ultimately found that that was very much rules-based and took some of the objectivity out of it that so many other faith-based types of investment solutions have. And so with that, our next step was to basically find an institution that could create these structured notes. And we talked to a variety of different companies, and BMO was the one that stood out the most as far as being very faith-based in their organization. And ultimately, what we did was we looked to them to help us create that faith-based structured note. And what it is that we take the Inspire ETF and their top 10 holdings with the best impact scores that they've run through their screening process, and we put them into an equally weighted basket stock. That becomes the engine or the driver of performance of these structured notes. And then on a monthly basis, we look at how we can implement them into one of three different categories. Those categories being a princely protected note, one that has full downside protection. We look at it in a buffered note where it has a certain level of downside protection, but with some upside potential. And then finally, we look at it in something that has a income note, something that has the potential to clip a coupon and generate some sort of annual yield for the client. And that's essentially what we've been doing every month, is finding clients and advisors who are interested in looking at one of those three categories and effectively crowdfunding the solution to get to the minimum that we need in order to launch that, which is $500,000. And then at that point in time, we create a legally binding document called a prospectus that has the QSIP, which is the identification number, then which our advisors then can go into their different custodians and purchase those accounts. But we've been very, very happy with the partnership of being able to provide something that, again, is aligned with people's faith-based beliefs. And Inspire has been a great, great partner in order to be able to do that.
Yes, as listeners will recognize that name. Inspire is a firm that I often talk about and have partnered with as well. Now, Brian, I just want to clarify a few things on what you'd mentioned. You mentioned a $500,000 minimum. Now, that's not per client. That's going to be for everyone who invests in it. We have to get the entire amount up to $500,000. Is that correct?
Exactly. And right now we're crowdfunding amongst advisors all across the country because ultimately what we're doing is we're saying, if you have $100,000, that's great. Let us know if you're interested. And then we'll go out to all the other advisors and see where they're at with their clients as well. And we've typically been coming out with about one or two different Inspire ETF structured notes a month because of the demand that we're having with all the different advisors. Specifically the ones that are doing a lot of biblically responsible investing.
Perfect. Now, is this something that people can go out and buy on their own, or do they have to work through an advisor for that?
You have to work through an advisor in order to get access to structured notes in general. Typically, the financial advisors are fiduciaries and are licensed in order to gain access to structured notes. And that's something that the FTC has just established to make sure that, because these things can be complex, they can be something that is hard to understand, they want to make sure that an advisor is there to help the client understand not only the benefits, but also the challenges that could exist with these particular types of investment tools.
Gotcha. Now, do individuals have to pay a fee to Barnabas or BMO to get into these? Are there any, ongoing maintenance costs or anything like that?
There's no annual fees associated with these particular types of products, but there is a cost associated with building these things. At the end of the day, BMO, Inspire, Barnabas, we're not nonprofits. We have to make money too to keep the lights on. And so what typically ends up happening is that if you invest $100,000, there's going to be about 2% that goes towards trading and origination costs. So that's again to keep the lights on, to buy to pay the traders, to pay for the computers, all that good stuff. But let's say you bought a principal protected note. You invested $100,000. Your first statement is probably going to show 98 cents on the dollar. But at maturity, your $100,000 is what is protected. Your $100,000 is what is used to base your performance off of. So it's almost like the costs are amortized over the life of the product, and as long as you hold the maturity, you effectively don't really pay for any cost. It's just the built-in trading and origination fees that were seen at inception that the client just wants to be made sure that they're aware of.
Gotcha. Now, when we talk about the caps and the limits, the buffers and things like that, that is not included in the fee. So we're not saying like, oh, it's 15, but really subtract out 2, so it's really 13. Those numbers are set and do not include the fee. Correct?
Exactly. Yeah. So that same example that I gave you about the downside is true on the upside. If you invest $100,000, let's say your cap is 12% on a 13-month note, cap is 12 and the performance of the underlying index is up 10, you end up taking home $110,000.
Gotcha.
Your terms are based off your initial purchase payment and they're net of any sort of costs or fees.
Okay. Is there anything else about these structured notes that you think our listeners should know about or be aware of?
At the end of the day, it's all about just making sure you understand the terms when they come out. And that's why, we work together to make sure that there's no surprises, right? At the end of the day, we try to disclose all the different challenges that could exist, as well as the benefits. But from my perspective, I guess the main thing that we haven't touched on that I always try to make sure to divulge is taxation. So just knowing that on principal protected notes, in qualified, you don't have to worry about any sort of taxes.
And when
In
qualified, you mean like
non-qualified,
IRAs and 401ks and things like
IRAs.
that. Yep.
Exactly. Yep. You don't have to worry about any sort of taxation, but in non-qualified, just know that there will be a tax form that gets sent to you each and every month. When it comes to income notes, you're obviously getting interest, so you're going to receive a tax form for the interest that you received. And then finally on the growth notes, those are taxed as long-term capital gains and they're tax deferred until maturity. So again, that's a lot to try to remember all in one, 30-minute podcast, but ultimately, whenever you do purchase one of these, that's something that I know Evan will kind of talk to you about, because ultimately, again, we understand that there are challenges that exist with any investment category that exists in the marketplace today, but because of the benefits with structured notes, we feel we can lay all of our cards out on the table, and the benefits significantly outweigh the challenges that exist.
Well, Brian, I really want to say thank you for taking your time to come out and talk with us today and kind of share your background and understanding on how these different options can work. For anyone who is interested in learning a little bit more about how these work and whether it makes sense for your portfolio or not, feel free to visit us at techwisefinancial.com, or you can give me a call directly at 719-413-5614. And as always, what we're looking to do is just help you align your faith and finances along the same path. Have a wonderful day.